Welcome to week 6. Today we're going to be talking about statement of cash flows. The statement of cash flows is classified into 3 different categories: operating activities, investing activities, and financing activities. The statement of cash flows is one of the most important statements for investors that they frequently look at. It gives them an understanding of where the company is spending their money and where their cash is coming from. Operating activities is the section of the cash flow statement that includes the effects on cash from those transactions that are used for continuing day-to-day operations. So on the cash receipt side, we have any collections for sales, and also interest and dividends are included as part of operating activities. So this is interest that we receive from notes receivables or dividends that we receive from investments that we've made. We don't include interest and dividends in the financing or investing section because it's a day-to-day occurrence. So they usually come in monthly. It's not a one-time thing. Then we have the payments that go out. So payments that we make for expenses and purchases are included here. Payments of interest, payments of income taxes, and other expenditures. So these are all our operating activities. For investing activities, these are typically activities that are involved in purchasing and selling plant assets, intangible assets, and investments. So here I want to be clear that when we're purchasing stock of other companies, that's included in investing. If we're purchasing or selling our own stock, then that's going to be a financing activity, and I'll get to that in just a second. So typically investing activities include property, plant, and equipment, and investments of other stocks and bonds, and then that's it. And collecting principal on loans that we make to other people. Financing is the final section of the cash flow statement. If you remember, we've talked about financing activities before, and there's 2 different types of ways that we can finance a company. You can either finance it through debt or finance it through equity and capital. All right, so any transactions related to equity are included in the financing section. Sorry about that, I'm in the middle of a software upgrade. So dividends, purchasing and selling our own stock, that's all financing. And then debt, long-term and short-term borrowings. The payment of and when we take out a loan, the proceeds from that are included in the financing section. So that's a brief summary of what goes into the statement of cash flows. Another thing to understand is that on the statement of cash flows, we're not talking just about cash. Included in the cash balance is also cash equivalents. So when you're actually looking at the balance sheet, that cash line item is typically referred to as cash and cash equivalents. Cash equivalents are short-term, highly liquid investments that mature within 3 months or 90 days. Typical examples are money market funds, commercial paper, and treasury bills or T-bills. So those are also included in the cash balance on the balance sheet and in the cash flow statement. So why do we need a cash flow statement? Well, you may remember that when we talk about our financial statements in accounting, it's on an accrual basis. So we match our revenue and expenses at the time that they're realized and incurred. Whereas cash basis is when we actually receive or pay the cash. Line items on the income statement and balance sheet are the balances based on an accrual basis. The statement of cash flows is on a cash basis. So the most efficient way to prepare the statement of cash flow is to look at the income statement and make adjustments for the changes in specific balance sheet accounts during the accounting period to translate the income statement from an accrual basis to a cash basis. And we're going to talk about what that means. There's 2 different methods to prepare the cash flow statement, and the 2 different methods differ specifically for the operating section only. There's the direct method and the indirect method. So for the direct method, what you're going to do is you need the income statement and you need the balance sheet, both the beginning and the ending balances. And you may need some additional detailed information about changes that occurred during the period in certain balance sheet accounts. So with the direct method, you're actually going to start with each line item on the income statement. So here we're talking about cash received from customers. So we're going to start with the revenue line item, sales, and then we're going to adjust it for increases and decreases in the accounts receivable balance. So the accounts receivable is from the balance sheet, and that is the balance sheet non-cash item related to revenue. So what we're looking at is we start with our net sales, which is an accrual basis, and we either add the decreases in accounts receivable or subtract the increases in accounts receivable. I've posted additional videos that go through specifically the concepts behind this and how to calculate this and why we do this. So I'm not going to get into the detail here. You'll see that you do the same thing for the interest income. You start with the revenue and you're either going to add the decrease in interest receivable or subtract the increase in interest receivable. And then we move on to our expenses. So the payments for purchases has two pieces. It has the cost of goods sold adjusted for the increase or decrease in inventory, and it also needs to be adjusted for the decrease or increase in accounts payable. And then we have all our other expenses. So you'll see that the expenses are adjusted for non-cash items, so depreciation or losses. Then you adjust it for increases or decreases in prepayments and decreases or increases in accrued liabilities. Again, I'm not going to get into the specifics of this because I've posted separate videos on the concepts behind why we do this. Cash flows from investing and financing activities are a bit more straightforward. Basically, you're simply looking at the changes in the related asset accounts during the year. Debit entries in these accounts represent purchases and credit entries represent sales. However, you need to look at whether or not there are any gains or losses on these transactions and adjust accordingly for that. So here's an example. We have purchases and sales of securities. So the $65,000 in debit entries represent purchases of marketable securities, which is a cash outflow. When you're buying something, cash is going out the door. And then we had $44,000 in credit entries representing the cost of marketable securities sold during the period. However, if you go back to the income statement, you'll see that these securities were sold at a $4,000 loss. Therefore, the cash proceeds from the sale amounted to only $40,000 because you had a cost of $44,000. You had a loss on that of $4,000, so $44,000 minus the $4,000 loss means that you only received $40,000 in cash. So you can see the summary of these transactions here. So our net cash received from purchases and sales of marketable securities is going to be a cash outflow of $25,000. Here we had loans that were made and collected. We had debit entries and note receivables representing new loans made during the year, and then credit entries showing collections on those loans. We also purchased plant assets during the year for $200,000. We paid $160,000 in cash, and we issued a long-term note payable for $40,000. You'll notice that only the $160,000 in cash shows up in the statement of cash flows. The portion that was financed through long-term debt is actually going to show up in a supplementary schedule because it's a non-cash item. However, you need to disclose it because it was in lieu of cash. So it exchanged the assets for a long-term debt. Therefore, we need to include it in the supplementary schedule. Here we have excuse me, here we had sales of plant assets. So again, you need to adjust this for any gains or losses. So the net credit entries total 44,000. That's the book value of plant assets sold. However, the income statement tells us that we had a gain of 31,000. So if the value is 44, you had a gain of 31, that means we actually got cash of $75,000. So you really need to understand the relationship of the value of the assets and if there was gains or losses on those assets. So here is what our total cash flow from investing activities will look like. So you'll see that cash outflows are negative numbers, cash inflows are positive numbers, and then we have a total net cash from investing activities. And in this case, we had net cash outflow of $115,000. Now we're going to move on to the financing section. So they had the cash inflows and outflows related to borrowing activities should be reported separately. So this example you can follow through in the full PowerPoints that are included in Engage. But basically we had proceeds from short-term borrowings of $45,000 and payments to settle the short-term debts of $55,000. They received cash of $100,000 by issuing a bond payable. And they issued capital stock for $50,000. Okay, so whenever you issue capital stock, your equity goes up and you're getting cash. They also declared and paid cash dividends of $40,000. If dividends are both declared and paid during the same year, then the cash payments are equal to the related debit entries in the retained accounts. However, if the balance sheet includes a liability for dividends payable, the cash is not going to be paid until the following year. So in order to determine the cash dividends paid, we adjust the amount of dividends declared by adding any decrease in the dividends payable account over the period. So here's a summary of all of the transactions that we discussed. And here for financing, we had a net cash flow from financing activities inflow of $100,000. I know I'm going through this kind of quickly, but I just wanted to give you a high-level understanding of the different sections of cash flows. And again, I have posted separate videos on actual practice problems and examples of how to calculate it. So you need to understand the relationship between the balance sheet and the statement of cash flows. So on the balance sheet, you'll have cash and cash equivalents at the beginning of the year, cash and cash equivalents at the end of the year. The difference between those should equal the net increase or decrease, of your cash and cash equivalents. That is going to be the total of your operating activities, your investing activities, and your financing activities. So the total of all those cash flows should equal the change on the balance sheet between the beginning and ending cash balance. All right, so as we mentioned, there's two different methods. The FASB prefers the direct method, but almost every publicly traded company out there continues to use the indirect method of preparation. It's just easier to prepare, whereas the direct method gives investors more information. So the direct method provides readers with the nature and dollar amount of specific positive and negative cash inflows and outflows. It looks at every single income statement line item and adjusts it for the non-cash items on the balance sheet. The indirect method begins with the net income total from the income statement and then makes adjustments to that number for the changes in the relevant balance sheet items and adjusts the net income for non-operating activities as well. So here's what the direct method looks like. And remember, this applies only to the operating section. So you can see that it has the items for each specific line item on the income statement, and it's cash received from customers, interest and dividends received, cash paid to suppliers, interest paid, income taxes paid, etc. You'll see that the net cash provided by operating activities is $50,000. On the next slide, this is what the indirect method looks like. So you start with your total net income, and then you adjust it for any non-cash items. So here, depreciation expense is non-cash, so we adjusted for that. Losses are non-cash items. For marketable securities, this is not an operating activity. Operating gain, again, on plant assets, this is not an operating activity, so we adjust it for that. So a loss reduces your net income. So in this case, we're going to add it back to our net income. A gain increases your net income. So in this case, we're going to reduce our net income to get it back to a cash basis. Then we're adjusting for each of the balance sheet items that had a change during the year. So in order to prepare the statement of cash flows using the indirect method, adjustments are required to reconcile net income with the cash flows. The nature and dollar amount of these adjustments are determined by the accounting using a worksheet or a computer program. They are not entered in the company's accounting records. The necessary adjustments include adjusting for non-cash expenses, like depreciation expense, adjusting for timing difference, which is the changes in the balance sheets, and then adjusting for non-operating gains and losses. This is a cheat sheet that you can use when adjusting net income for operating cash flows. For current assets, you're going to, if there's an increase in a current asset, you're going to subtract it for net income. If there's a decrease, you're going to add it to net income. For current liabilities, it's the opposite. So if you have an increase in the account balance during the year, you're going to add it to net income. And if you have a decrease, you're going to subtract it for net income. Okay? So here's a summary of adjustments. You can refer to this when you're doing your homework if you get stuck on anything. And I'm going to go through the theory behind this in the supplemental videos. Please let me know if you have any additional questions. Thank you.